Nestled amidst the rolling hills of Kentucky lies Fort Knox, a military base shrouded in mystery and intrigue. More than just a military installation, Fort Knox houses the United States Bullion Depository, a heavily fortified vault rumored to hold a significant portion of America's gold reserves. Its very name evokes images of impenetrable security, with layers of armed guards, reinforced concrete, and sophisticated alarm systems. For decades, Fort Knox has captured the public imagination, becoming synonymous with safety, wealth, and the enduring power of gold. The fortress-like structure has been featured prominently in popular culture, often serving as the backdrop for thrilling heist movies and captivating novels. Despite its fame, Fort Knox remains an enigma, its true contents hidden from public view. Few have ever stepped foot inside its vault, and the precise amount of gold it holds remains a closely guarded secret. This secrecy, while intended to protect the nation's wealth, has also fueled speculation and conspiracy theories, adding to the mystique surrounding this enigmatic American landmark. The story of America's gold reserves begins long before the construction of Fort Knox. The journey of gold in America is a tale of ambition, exploration, and economic strategy. From the early days of European settlers, gold was seen as a symbol of wealth and power. The discovery of gold in the New World fueled dreams of prosperity, and led to significant historical events that shaped the nation. In the early 20th century, the United States, along with many other countries, adhered to the gold standard. This meant that the value of the US dollar was directly tied to a specific amount of gold. The gold standard provided a stable foundation for international trade and economic growth, as it ensured that currencies had a tangible value backed by a precious metal. This system linked the value of a nation's currency directly to the amount of gold it held in its reserves. The more gold a country possessed, the stronger its currency and economy were perceived to be. This created a global race to accumulate gold, as nations sought to bolster their economic standing and secure their financial futures. As a young and growing nation, the United States actively accumulated gold, viewing it as a symbol of economic strength and stability. The government and private sector worked hand in hand to mine, trade, and store gold, ensuring that the nation's reserves continued to grow. This accumulation was not just about wealth, it was about securing America's place on the global stage. The discovery of gold in California in 1848 sparked a frenzy of mining activity, further bolstering the nation's gold reserves. The gold rush attracted thousands of prospectors, entrepreneurs, and adventurers, all hoping to strike it rich. This massive influx of people and capital transformed California and significantly increased the amount of gold flowing into the U.S. Treasury. Throughout the late 19th and early 20th centuries, the U.S. government continued to amass gold, establishing itself as a major player in the global gold market. The government implemented policies to encourage gold mining and acquisition, ensuring that the nation's reserves remained robust. This strategic accumulation of gold was crucial for maintaining economic stability and fostering growth. This accumulation reached its peak during the Great Depression, as people sought the safety and security of gold amidst economic uncertainty. The stock market crash of 1929 and the subsequent economic downturn led many to lose faith in paper currency. Gold, with its intrinsic value, became a safe haven for those looking to protect their wealth during these turbulent times. In 1933, President Franklin D. Roosevelt took the dramatic step of confiscating privately held gold, forcing citizens to sell their gold to the government at a fixed price of $20.67 per ounce. This happened seriously under Order 6102, signed on April 5, 1933. If they didn't, they could face up to 10 years in prison or a $10,000 fine, which is around $230,000 in today's dollars. This bold move was part of a broader strategy to stabilize the economy and restore confidence in the financial system. By consolidating the nation's gold reserves, the government aimed to strengthen the dollar and lay the groundwork for economic recovery. So once the government had enough gold from the public, it promptly raised the price of gold to $35 an ounce in 1934 under the Gold Reserve Act. In other words, the government stole your gold for $20.67, then immediately revalued it higher and devaluing the dollar by 69%. This unprecedented move, while controversial, further consolidated America's gold holdings. In the early 1930s, the United States was grappling with the Great Depression, a period of severe economic downturn that affected millions. President Franklin D. Roosevelt, in an effort to stabilize the economy, signed Executive Order 6102 in 1933, which required American citizens to surrender their gold coins, gold bullion, and gold certificates to the Federal Reserve. This move was aimed at preventing hoarding and stimulating economic growth by increasing the money supply. The confiscated gold was then melted down and added to the national reserves, significantly boosting the country's gold holdings. The confiscated gold, along with the existing reserves, were used to back the U.S. dollar, which had become the world's leading reserve currency. This decision was pivotal in establishing the United States as a dominant economic power on the global stage. By backing the dollar with gold, the U.S. government aimed to instill confidence in its currency, both domestically and internationally. This move also facilitated international trade as other countries began to hold U.S. dollars as part of their foreign exchange reserves, knowing that these dollars could be exchanged for gold at a fixed rate. To solidify this new system, the gold price was fixed at $35 per ounce in 1934, a value that would remain in place for decades. This fixed price was intended to provide stability and predictability in the financial markets. By setting a fixed price for gold, the U.S. government aimed to prevent fluctuations in the value of the dollar and ensure that the currency remained strong. This policy was part of the broader New Deal reforms introduced by President Roosevelt to revive the American economy. Fort Knox, completed in 1936, became the central repository for this vast accumulation of wealth, a symbol of American economic might. The construction of Fort Knox was a monumental task, involving the use of thousands of tons of granite, steel, and concrete. The facility was designed to be one of the most secure places in the world, capable of withstanding any potential threats. Over the years, Fort Knox has housed a significant portion of the nation's gold reserves, serving as a testament to the country's financial strength and stability. The fixed gold standard, however, proved unsustainable in the long run. While it initially provided stability, it also imposed rigid constraints on the economy. As the global economic landscape evolved, the limitations of the gold standard became increasingly apparent. The fixed price of gold restricted the ability of governments to respond to economic crises and adapt to changing conditions. This rigidity ultimately led to economic imbalances and financial instability. As the global economy evolved, the fixed price of gold created distortions in international trade and finance. Countries with trade surpluses accumulated large amounts of gold, while those with trade deficits saw their gold reserves dwindle. This imbalance put pressure on the international monetary system and led to calls for reform. The fixed gold price also limited the ability of central banks to manage their monetary policies effectively, as they were constrained by the need to maintain gold reserves. The United States, burdened by the costs of the Vietnam War and facing inflationary pressures, began to experience a decline in its gold reserves as other countries redeemed their dollar holdings for gold. The economic strain of the war, coupled with rising inflation, eroded confidence in the U.S. dollar. As countries sought to exchange their dollars for gold, the U.S. found itself in a precarious position, with its gold reserves rapidly depleting. This situation highlighted the inherent vulnerabilities of the gold standard and underscored the need for a more flexible monetary system. This pressure on the dollar led President Richard Nixon to abandon the gold standard entirely in 1971, effectively ending the direct link between gold and the U.S. currency. Nixon's decision marked a significant turning point in the history of global finance. By severing the tie between the dollar and gold, the U.S. government gained greater flexibility in managing its monetary policy. This move paved the way for the modern era of fiat currencies, where the value of money is not tied to a physical commodity, but is instead based on the trust and confidence of the people who use it. The decision to abandon the gold standard had profound implications for the valuation of America's gold reserves. When President Nixon made the announcement in 1971, it marked the end of an era where the value of the U.S. dollar was directly tied to a specific amount of gold. This move was intended to address economic challenges, but it also introduced a new level of uncertainty and complexity into the financial system. With the gold price no longer fixed, it was free to fluctuate based on market forces. This meant that the value of gold, could now respond to supply and demand dynamics, investor behavior, and broader economic conditions. The gold market became a more volatile and unpredictable arena, reflecting the changing tides of global finance. Over the ensuing decades, the price of gold has experienced periods of both boom and bust, influenced by factors such as inflation, geopolitical events, and investor sentiment. For instance, during times of economic uncertainty or political instability, gold is often seen as a safe haven asset, leading to spikes in its price. Conversely, during periods of economic stability and growth, the demand for gold may wane, causing prices to drop. While the official U.S. gold reserves are still valued at the outdated price of $42.22 per ounce, this figure is a relic of a bygone era. It does not reflect the current market realities where gold is traded at much higher prices. This discrepancy highlights the gap between historical accounting practices and modern financial markets. The market price of gold has soared far beyond this level, often reaching several $1,000s per ounce. This significant increase in market value underscores the growing demand for gold as an investment and a hedge against economic uncertainty. Investors around the world closely monitor gold prices, making it a critical component of global financial markets. This disparity between the official and market values of gold has fueled speculation about the true extent of America's gold holdings. Some believe that the U.S. government may be underreporting its gold reserves to maintain a strategic advantage or to influence market perceptions. This lack of transparency has led to various theories and debates among economists, investors, and policymakers. Some analysts argue that the U.S. government has a vested interest in downplaying the value of its gold reserves to avoid undermining confidence in the dollar. By keeping the official valuation low, they suggest the government can prevent potential market disruptions and maintain the stability of the U.S. currency. This perspective sees the outdated valuation as a deliberate strategy rather than a mere oversight. Others contend that the outdated valuation is simply an accounting quirk with little real-world significance. They argue that the official price is a historical artifact that does not impact the actual trading and investment activities in the gold market. According to this view, the market price of gold is what truly matters, and the official valuation is just a footnote in financial history. Regardless of the reason, the lack of transparency surrounding the true value of America's gold reserves continues to raise eyebrows and fuel skepticism. The ongoing debate highlights the complexities and challenges of managing national assets in a rapidly changing global economy. As long as questions remain unanswered, the intrigue and speculation about America's gold reserves are likely to persist.